Hello, my name is Matthew Morrow of Morrow Insurance Company. I want to thank you for sampling my DVD today. My hope is that you will learn something valuable about long-term care insurance. I find that it's so amazing that so many people don't know what this product is or what it covers. This is a 1 in 2 chance that you will need a long-term care policy. Okay, auto insurance is 1 in 40. This is something that you need to look at with your retirement planner and certainly for your nest egg. I thank you for your time and your attention. Hello everybody, I would like to thank you for coming to my long-term care seminar. There are a lot of misconceptions about long-term care, what it costs, what it covers, who qualifies for it. We're going to go over Medicare and Medicaid, all kinds of good stuff today. I'll do my best to just give you the important information. I'm thankful that you're here. My name is Matthew Morrow, and I have Morrow Insurance Company. And for the last 6 years or so, I've dedicated the majority of my work to providing long-term care insurance for people. I'm constantly amazed at how many people not only are not prepared for the future, but they are not prepared for what is to come. And I hope that through this seminar you can learn a few things, and we'll jump right into it. A lot of people come to me and they tell me that they have long-term care insurance. I said, "Do you have long-term care?" "Well, yeah, I do." And they get that confused with long-term disability, and or they think that, oh, Medicaid covers that, and that's why I'll be covered. A lot of these are misconceptions. Some of them are flat out wrong. And so hopefully today I will take care of those questions for you. Let's go on and get started. What is long-term care insurance? Long-term care insurance is insurance that provides for someone that is no longer able to provide for themselves, essentially. It's a prolonged illness, a disability, cognitive impairment, which I have a lot of people say when I ask them, especially on an application, if they have cognitive problems, they say, "Well, I can't remember very well." And I say, "No, please don't say that. That's not what I mean." We're talking more like Alzheimer's, some type of medical condition, of course. Long-term care insurance was introduced in the 1980s. Originally, it was just nursing home insurance, essentially. People didn't want to go to a nursing home, and there was that big fear about nursing home. I'll tell you a little bit about statistics. You want to make sure when you hear statistical data, which I'm going to give you several today, that you know what you're hearing. So you want to be able to draw the correct conclusions, and hopefully I'm going to help you do that. You could easily say ice cream sales are higher in the summer. Crime is also higher during the summer months. So therefore, ice cream equals crime. Of course, you cannot draw that conclusion. That would not be good. But a lot of people do the same thing when they're talking about their nest egg or their retirement fund. And I believe that long-term care insurance is the most necessary thing right next to life insurance that you will need to protect your assets, your nest egg. The reason this is, most of you have car insurance, homeowner's policy. To use your car insurance is a 1 in 40 chance. Okay? To use the likelihood that you're going to need long-term care insurance is 1 in 2. It's a little over 40%. If you were on the way home today and half of the houses, okay, that you were on your way home, half the houses were either on fire, hit by tornadoes or something, you'd make sure your homeowner's policy was paid up, of course. We want to make sure that your nest egg, the things that you've worked so hard for, which is one of the reasons I'm even in the business, is my family works so hard with their own businesses and then don't have any retirement. They don't have the proper insurance. And that's one of the reasons why I'm in this, is because I really want to help people to be prepared for what's to come. It's not something that necessarily might happen. It's almost an inevitability. Something to keep in mind, long-term care is not disability insurance. A lot of people get that confused. They'll say, "Oh yeah, I've got disability through Aflac." You might have disability, but you don't have long-term care more than likely at your office. Disability pays for 60% of your income. It is to help you replace your income while you're working. That is not what long-term care insurance is. Most policies cover in-home care, adult daycare, assisted living, nursing home, hospice care, and we'll go over each of those in detail now. Who needs this insurance? We already said that 1 in 2 Americans. If you're sitting beside your husband or your wife, I encourage you to look at them, and more than likely, one of you is going to need long-term care of some type. And you might say, "Oh, we're not going to go into a nursing home." Keep this statistic in mind: only 15% of all care given is for nursing homes. Okay? The majority of the care that's given is in-home care, adult daycare, and assisted living. Okay? So you need to keep that in mind, because what inevitably happens is that people say, "Oh, I don't want to go to a nursing home," when really that's the last stage. And we're going to talk more about that as we go along. Right now, over 12 million Americans receive some form of long-term care insurance. All right? And this is a great percentage. It's a statistic. 40% of those that are currently receiving long-term care in whatever way are of working age. A lot of you are thinking this is old folks insurance. I'm not old yet, so I don't need this insurance. I would encourage you to take a second look, because 40% is a large number. We have a lady at my church where I go named Dawn Anderson, and she gave me permission to use her name. She is 41 years old, was getting out of bed one morning to go to work like she normally did. Her foot got caught in her comforter, and she fell and hit her neck on her side table. She's now a quadriplegic. It's a really sad situation. Her husband left her and her children left, and she is now receiving nursing home care full-time here in Montgomery. We have a neighbor a few doors down from us. I don't want to use his name, but it's a young man, 15 years old, out riding his four-wheeler like he normally would, and hit a bump wrong, and when he fell, he broke his neck, and now he's paralyzed from the chest down. I'm not saying these statistics to scare people into buying a policy. That is not what I'm doing. I just want to let people know that this is something that can affect you, and it can affect you at any age. The Council on Aging that was put together by the Senate and Congress together said, the good news is we're living longer. The bad news is we're living longer. The life expectancy after age 65 has increased to 17.9 years. It's nearly 18 years that our life expectancy, and they're doing things daily to prolong that. Artificial heart, stem cell research, there's all kinds of things that are going on to extend our lives, and it's working. In fact, I have an aunt right now that is 100 years old. People are aging every day. The majority of people, like I said, are scared about going to a nursing home. The majority of people that receive care aren't in a nursing home. More times than not, they're receiving in-home care. I personally and my family have an adult, my great uncle, my great grandmother, my great aunt, my uncle, my aunt, my mother have all received long-term care in one form or another. And they had to come out of pocket for it themselves, and they are continually receiving care because the quality of care that is available is kind of scary. It's not near as good as the quality a family member would provide. And we're going to talk more about that in detail. One of the things that I always find interesting is that insurance agents want to sell you a policy. And I am an insurance agent, and I would like to sell you a policy, but not if you don't need it. So I'm going to do something that most insurance agents don't do, which is tell you, do you really need this product? If you were considering a long-term care insurance policy, we'd consider your age, your health status, which we're going to go over in a second. Your overall retirement goals. There's a lot of us out there, I'm going to tell you here in a minute, if you can't afford it, you shouldn't buy it. Your income and your overall assets. If you have limited income, you should not buy this product. If you rely on Social Security benefits, or if you're already receiving care, if you have a major illness, or you can't perform your ADLs, you should not buy this product. Now, what are ADLs? ADLs are active daily living functions. There's several of them. If you can't bathe yourself, feed yourself, you are not cognitively able, you can't transfer, which would be getting in and out of a chair. And a lot of people, please, I'm going to talk about this later, that different companies do selling points to say, well, we only have 2 ADLs that you have to have our policy start. And others say, well, we have 3. This should not be a buying factor when you go to purchase your long-term care policy. And the only reason I say that is, if you are confined to a bed, you already can't do more than 2 of your ADLs. You understand? If you're confined to a bed, you already can't transfer. You can't feed yourself. You can't bathe yourself. So don't you let a trigger be the reason why you do or don't buy that policy. 2 or 3, I don't think it matters personally. Most policies are activated, like I said, by 2, but some are more. These are the ADLs that I just spoke of: eating, dressing, bathing, toileting, transferring, cognizance. Why you should consider buying long-term care. I think the majority of the people that I know that are middle income or better should seriously consider a long-term care policy. If you don't require Social Security benefits to make your living, if you are free of major illnesses, if you've not been confined to a nursing home in the last 3 years, and most of all, if you want to protect your retirement. I know a lot of people that spend their whole life to get that nest egg so that they can travel, or so that they can spend time with their grandkids, or so they can live out the rest of their life in peace because they've put in enough work. The problem is that with 1 and 2 going into some type of long-term care, that nest egg can go in a hurry. And we're going to talk about prices here in a minute about how much long-term care actually costs. Long-term care costs a lot of money. I want you to sit, and as you're thinking right now, I want you to think how much I have in my retirement account, your IRA, your Roth, your 401k, your 403b. How much money do you have in assets? Then I want you to think about 2 things, and we're going to talk about this a little later about Medicaid. There's really only 2 ways to pay for long-term care, and that's either you come up with the funds yourself, personal income, assets, or the government pays. For the government to pay, you have to have nearly nothing. You have to qualify for welfare. So you've spent your entire life gathering these assets and putting away and saving for a rainy day so that you can spend your retirement, and with upwards of $100,000 a year. Does that sound crazy? It does sound crazy. How much do you have in your retirement account? Do you have $100,000, $200,000, $300,000? Do you know the average nursing home stay in Alabama right now is about $115 per day? You know, you're looking at $35,000 to $40,000 a year. I have several people that have come to me and told me that they not only have in-home care, but they pay for a sitter. They pay for somebody to stay with their family member throughout the day, especially if they have Alzheimer's or some type of disability where they can't function like they should. And these people can pay somebody full-time upwards of $60,000. So not only do you have the in-home care you're paying for, you then have somebody to sit with that family member. Or you have to take off work to do that. It can be very time-consuming and cost quite a bit of money. Obviously, assisted living, they have some very nice assisted living places. And we're going to talk about later on how your freedom to choose which place you go is taken away if you don't have a policy to pay for it. If you're not paying for it yourself, the government decides where you do or don't go. If there's an open bed, it doesn't matter that you're not near your family necessarily. It matters that that's where an open bed is. And since you're not fitting the bill, they will send you where you need to go. Elmcroft Assisted Living is just one place here in Montgomery. They specialize in Alzheimer's patients, and this is just what they cost, $111 per day, nearly $40,000 per year. Like I said, personal resources, that's how you're going to pay for this policy. That's how you're going to pay for your long-term care needs. Most people don't realize how this happens, but as we dig deeper into it, you're gonna understand that it takes quite a bit of assets. What's your house worth? Is it worth $150,000? Is it worth $250,000? We're going to get into that. At age 65, a lot of people think that Medicare is going to cover them. I'm going to make a big distinction for you between Medicare and Medicaid. Medicaid is a welfare program for poor people. Most people are not in that realm where they need government assistance. Medicare is essentially your health insurance. There's a Part A and a Part B. I'll just read this here. Medicare is the nation's health insurance program for all people 65 years of age and over for certain disabled persons. Run by the Centers for Medicare and Medicaid Services of the U.S. Department of Health and Human Services, the Medicare program is divided into two sections, which we'll go over now. There's Part A and Part B, like I mentioned. Part A pays for inpatient hospital care, skilled nursing care, and home health and hospice care. And Part A has deductibles and coinsurance, but most people don't have to pay for premiums. A lot of people say, oh, well, no, wait a minute. Medicare does cover long-term care. Hold that thought. Medicare will cover you for up to 100 days for what's known as skilled care. That means a doctor or physician's care. I'm sure you know of people that have had some type of major surgery and they needed gauze changed or they needed rehabilitation. Those people, per doctor's orders, would go to a skilled care assisted living place for rehabilitation up to 100 days. Okay? That's if you qualify up to 100 days. The majority of care given, almost 95% of the care given in these facilities is not skilled care. You don't need a doctor 24/7. It's custodial care. It is bathing. And not to be gross, but it's toileting. It's transferring from a bed to a chair. It's your daily living functions. You wouldn't need a skilled doctor 24/7. You would need someone to take care of your basic needs. And that's the big difference. Medicare B helps pay for doctor services, outpatient service, durable medical equipment, and a number of other medical supplies and services not covered by Medicare Part A. Part B has premiums and deductibles as well. What does Medicare pay for? Just like I said before, 85% of the care that's given is not skilled care by a doctor. Medicare will approve some cost, but Medicare will only cover you up to 100 days. That's 3 months or less. That's if you qualify. The synopsis of this is Medicare does not pay for assisted living. Medicare does not pay for home health care unless already receiving care at home. By the way, this is extra care. Most also directly be related to care already being treated for. So essentially, a doctor has to prescribe it, and you have to qualify, and it's only 100 days. You should not require or rely on Medicare to cover your long-term care needs. Okay? Let's go on to the next slide. Just something to let you people know on, any of you that are reaching retirement age, you're probably already receiving the NARP magazine. My mother knew. She said the day she turned 50, she received one of those magazines. She said, "Oh my goodness, I'm getting old now," because she's starting to remember getting a member of the AARP mailers. And this is true, of course. But one of the things that's important about Medicare is if you don't currently have, if you are qualified for Medicare, you're 65 or older, and you don't have a Medigap policy, I would seriously encourage you to talk to a financial advisor about a Medigap policy. They kind of fill in the gaps where Medicare has holes, and they are very useful. Now, for the long-term care part, I said if you qualify, plans D, G, I, and J pay up to $1,600 per year. Per year. What did we just say long-term care cost? Around $3,000 to $3,500 per month for assisted living or nurse home care. It's very important to keep that in mind. Let's go on to Medicaid. As I told you before, Medicaid is a program funded jointly by the federal and state government that provides medical benefits to certain low-income individuals. Essentially, Medicaid is welfare. And most of you hopefully do not have to rely on Medicaid to survive. Remember, if you are of a low-income status, I do not think that this product would be good for you. If you are middle income or better, I think you should seriously look at this. These are some of the things that people qualify for Medicaid. Back in the early 80s, there were a lot of financial advisors that were doing something that they've shut down now, which is qualifying you for Medicaid. That was part of the retirement plan. So as you aged, they would take your nest egg and they would put that money in trust. They would put it in annuities. They would put it in other assets to take it officially out of your name, but you could continue living on that money even though it was in your son or your daughter's name. So your children would essentially get their inheritance, but you could continue living off your nest egg and still then qualify for government assistance. In the last few years, I don't know if y'all realize this, but we've been at war. And the government has initiated a Deficit Reduction Act, which essentially means that they've increased the look-back period and what you are and are not allowed to do this. The welfare program was not intended to pay for you, okay? The welfare program was intended to pay for people that can't pay for themselves. There's a lot of people that take advantage of the system, but the government has seriously cracked down on what they cover and how you qualify. So they've made it illegal for you to put all your money over in a trust and expect for the government to pay for you. The government has they initially set it up to 3 years. Now it's 5 years. I have another friend at church, Barbara Fennell and Judy Brown, and their mother went through this, and they knew that the time was coming where she was going to be put into a nursing facility, and they started getting rid of her assets, putting them in their name. But they got to the 3-year mark, and their mother, unfortunately, did have to go into a facility. Well, what did the government do? Even though she had sold her house and all that kind of good stuff, they still looked back through a total of 5 years. Okay? So any assets that she had, they included those. So essentially, if you sell your house, say your house is worth $100,000, you sell your house for $100,000, but it's within that 5-year period, and you're trying to use that money to get that money out of your estate for your family members, government's going to say, no, I'm sorry, you are responsible for your long-term care. You are responsible to pay for your family members. So they will take that $100,000 off the top before you can qualify for a welfare program, which is what a lot of people have tried to do. Like I said, the disposal of resources is restricted. Plus, you have to medically get approved for Medicaid, which is highly unlikely. As I mentioned, the Deficit Reduction Act, it also has increased gifting, the spectrum in which gifting is looked at. A lot of people you could gift up to $10,000 to children, grandchildren, family members, and take that money out of your taxable income, your resources. So essentially, you could give away, if you say you had 10 grandkids and 5 children, you could essentially give $150,000 a year away and it be taken from your taxable income. The government is not allowing that anymore. They've increased the scope on that. Bottom line, Medicaid does not cover you. You should not rely on Medicaid for your long-term care needs. This is important. The biggest thing for me and for my family members, one of the reasons I'm so passionate about long-term care is because you don't get to choose where you go. If you're being paid for by the government, you lose your freedom to say, oh, I want to go to that nice place down the road. That's where I want to be. No. If there is an open bed somewhere and the government's fitting the bill, you get sent to where there's an open bed. You lose your freedom to say, I want to be around family members and friends or get to choose exactly where I want to be. You also, and I would like to say, I'm certainly not going to mention any companies' names, but the quality of care you receive is different. Okay? Let's just be honest for a second. People are people, okay? And there are differences in the care that you receive depending on the different places you go, okay? So you can check with different companies, but I guarantee you there are some nice places and there are some not so nice places. So this takes away your freedom if you don't have to pay for it yourself. Here's the Montgomery Medicaid District Office here for Montgomery, and you can contact them if you like. Now we move on to in-home care. This is probably the greatest overlooked part of the product, but probably one of the most important is the in-home care. In-home care is obviously in your own home. Now think about this for a second, because a lot of people don't think this way. This might be a revelation to you. Insurance companies are in business to make money, okay? That is the point of being in business, is to make money. Now a lot of people say, oh, well, my insurance company loves me and wants to take care of me. They might. I'm not saying they don't, but what I am saying is that they are in business to make money, okay? They are a business, and that's what businesses do, okay? Insurance really want the opposite. Insurance is really the opposite of what you're thinking about, okay? So life insurance is really to protect from death insurance. Health insurance is really when you're not healthy, right? Car insurance is really for when you break your car, right? So you understand? In-home care is a great, great thing because imagine you've been disabled, you cannot perform several of your daily functions, your ADLs, and you need to start receiving care, and you're going to have to go to assisted living place because you're in a wheelchair now. The insurance companies would rather, and you would rather this as well, if they can come into your home, build you a ramp, widen your doors, lower your countertops, and put a few handicap or wheelchair accessible items throughout your house, they're going to do that, aren't they? If they can spend, say, $15,000 doing a few modifications to your house, number one, you're happy because you got to stay at your own home instead of going to a facility. But two, the insurance company is happy because they just paid out $15,000 and you require no more care and you're happy. Okay? Whereas a facility would cost them, like we said before, $30,000 to $40,000 per year. So the insurance company is happy when you go to in-home care too, and so are you. A lot of people buy these policies because they're afraid they're going to go to a nursing home. Remember, nursing home care only makes up 15% of the care given. Okay? So we want to make that distinction. So most people want to go to their home first, and you would too. I currently have 2 family members that are receiving in-home care from another family member because they don't have money to take care of themselves, and the family member does not want them to go to a nursing facility or an assisted living place. So they take care of them themselves. So in-home care is really the first stage, not the adult daycare, the assisted living, and the nursing home care is really on down the road. In-home care comes first. Let's go on to assisted living. Most of you know what assisted living is or have a family member or a friend. If you have a church bulletin, there's probably a care needs section with members of your church family that are receiving nursing home care and are called shut-ins or sometimes happy hearts, or they have different names, but I'm sure you have a list of those. Assisted living places are just that, to assist. Many of them are very nice. They're almost like apartment complexes. They have daily activities that they will provide. They have 3 square meals a day, exercise programs. Most of the assisted living places that you would go in, if you have one of these policies or are able to pay for it yourself, are pretty nice. They're just that, assisted living. There are even many people that choose to go to an assisted living place because all their children have left and have their own lives. And a lot of people actually choose to go to an assisted living place because of the security, because they don't have to necessarily prepare meals. But some of the places actually have, like I said, little apartments. So you have your own kitchen, you can prepare your own food, you can come and go as you please. Many of the places not only provide bus services to go to the bank or to the mall or wherever you'd like to go, but a lot of people are still able to drive and actually have their car sitting out in the assisted living parking lot. So that's important to remember as well. Adult daycare. This is one of those things that I almost hate talking about, but it is a reality. So we really need to cover it. Adult daycare is just like child daycare. Okay, you've got your family member that you love and care for, and they can no longer provide for themselves, but you can't afford to provide for them 24/7. So an adult daycare program is just the same as a child daycare program. You will drop your parent or loved one off at this adult daycare, sign them in just like you would a child, and they stay for the day or for a half day, or really sometimes people just need a break and they'll pay for a couple of days that their family member can stay at an adult daycare so that they can just relieve some of the pressure. It is not only the monotony, but dealing emotionally with family members can be very, very heavy. So adult daycare, that's what that takes care of. Nursing home care, of course, what everyone is so afraid of going to, and rightly so. It can be, if you've ever visited a nursing home, there are, not saying all of them certainly, but there are people that it's such a lonely place that a lot of times when people do get sent to a nursing home, kind of out of sight, out of mind. I know that sounds terrible, but it's kind of true that people that are living in nursing homes just are aching and begging for attention and for a loved one to come and sit and speak with them. And that's why a lot of times people will have someone there, but they will also pay for a sitter just to come and spend time with their family member when they can't. Remember, nursing home care only covers about 15% of the care given. And that's really, really important because that's what people think of when they think of long-term care. When in actuality, 85% of the care is not in a nursing home. These policies today, policies these days are comprehensive. When they first came out in the 80s, they were just nursing home care for the most part. Now they cover all kinds of things, nursing home, assisted living, adult daycare, in-home care, and hospice care. Most of you know what hospice care is. It is caring for someone that is in their last days, most of the time 6 months or less to live. It is very rare that a person will be put on hospice and get better. It's very rare. It does happen, thankfully, but for the most part, hospice care is called in as a last resort, and of course that is provided in these policies. Most all of these policies have a free hospice care, which is very nice and comforting to have a company that will come in and help take care of your family member in those days and comfort them, not only emotionally but spiritually with the family members. It's a very, very nice thing that the companies don't have to do, but it's an added value. Going to go over some details real quick, and I hope not to lose you in the details, but I think these are important. These are unilateral contracts, meaning you. The only reason, and once you're approved, the only reason a company can cancel your policy is for non-payment. Okay? If you don't pay the premiums, they will cancel your policy. Most policies, when any good agent that is selling a policy to you will more than likely have a waiver of premium. So after you start receiving care, you are no longer liable or a family member for the premiums. And they also, when you sign up, actually have you pay most of the time for 2 months, a month in advance, just to keep that. They also offer draft straight out of your checking or savings account so that you won't have lapse of coverage. These are portable, meaning that you can go anywhere within the United States. You cannot go to other countries with most of these policies, but within the United States you can receive care. Like I've said before, they are comprehensive. They cover, they're not like the ones that were sold in the 80s that were just nursing home care. They cover a multitude of different products. They are guaranteed renewable. This means that every year your product is going to continue, okay? This does not mean that your rates are going to be fixed. Now, the products that I sell and many others have a rate guarantee, and those are important because they're not going to say, hey, you, Karen, we're raising your rates, okay? They're not going to do that. What they can do is just like your car or homeowner's insurance, they can say, every female in the state of Alabama that is between 45 and 52, we're raising your rates 3% or 5%. They can do that legally if they do an across-the-board rate increase. Majority of the time, companies will advertise that they have never had a rate increase. We've never had a rate increase. And I'm going to talk a little bit more about marketing here in a second. But you need to keep in mind that that's not necessarily the case, okay? That's not necessarily the case. We also, I'm inflation riders. I personally will not sell a policy without an inflation rider. You want to understand what inflation is? In '96, gas was under $1. In 2007, gas is nearly $3. That's inflation. The buying power of your dollar. I had my grandfather bought one of those burial policies, paid for 15 years on that policy, and it did not have an inflation rider on it. So when my grandfather passed away, where he thought he had taken care of his funeral expenses, they got to the funeral home and that policy only paid $250. And he had paid $15, $20 for 15 years. Okay? So the buying power of that inflation, if you're younger, you need to consider a compound inflation, which I know you understand compound interest if you have a credit card, but it works for you instead of against you. So that every year, your bucket of money essentially is what you're buying when you buy a long-term care policy. Your bucket of money is going to go up every year. Guaranteed rates, like I said before, you can lock in to the price that you start paying, and you can guarantee that rate for the life of the policy if you choose that rider. Quickly, products are flexible. Most times when I choose a policy to sell, the elimination days, that's how many days can you afford to pay for yourself. Normally, I choose 90 to 100 days because that's 3 months worth of care. Most of the time, the Medicare, if you're covered by Medicare, that will pay up to 100 days if you qualify. And if you're of working age, I assume that you can pay for 100 days, 3 months worth of care. Okay? We've already talked about inflation riders. You do need to keep in mind that the inflation riders can add anywhere from 25 to 40% of the total premium, which is quite a bit. The days of coverage, which is the bucket or pool of money that I just mentioned, there are multiple payment options. You can do monthly, weekly, quarterly, yearly, or even a single pay where you pay one time for a policy paid in full at one time. You can pay up. I'll pay up my policy by age 65, paid up in 10 years, 20 years. There's just tons of ways of doing that. Waiver of premium, I already mentioned earlier, waives the premium for your policy if you choose. Some policies have that automatically into the policy. Some have them as a rider. Okay? Restoration of benefits. There are riders that have Essentially, you buy your $100,000 bucket of money or whatever your bucket of money is that you pay for, and you use that policy. You have to go into a nursing home or an assisted living, and say you use it for a year, and $30,000 of your bucket of money is gone. You're down to $70,000. There are a lot of companies that will offer a restoration of benefits where if you are healthy for 6 months or more, they will restore your policy to the original $100,000 bucket of money, which is nice. Downgrades of policies. Remember, you can always go down on your policy if you start and say, hey, I want a $300,000 bucket of money, and then later on in life you say, I've gathered enough assets or I have other things that are taking care of this and I want to lower my benefit. You can. You cannot, however, increase your benefit. If you call up a company and say, hey, I want my long-term care policy to go from $100,000 to $300,000, they're going to want to underwrite you again. They want to know why this person all of a sudden wants more coverage, because more times than not they feel that something's wrong with you. Okay? Non-forfeiture benefit. One of the questions I get asked more times than not, and it just amazes me, am I going to get any cash benefit out of this? Does this have a cash benefit? For the most part, no, it doesn't. And people say, well, you mean I'm just throwing this money away? No, you are buying peace of mind. You are protecting your assets, your nest egg, and your family members, and giving yourself freedom to choose where you go and how you're cared for. Okay? So this is not just throwing money away. The majority of the insurance you pay for, your car insurance, your homeowner's insurance, cancer policies, disability, none of those are cash-bearing policies. Universal life or whole life insurance are really one of the only, and some annuities are the only forms of insurance that have cash benefits. So when you go to purchase this, do not expect to get any kind of cash benefit off of it. Quickly, if you already own a policy, should you switch? Most times you should not, because you've already made it through underwriting. And in the last 5 years, policies have increased quite a bit of what they cost. When I started in 2001, I could sell a fully loaded policy for $30, $40. Now that same policy is $100. Okay, part of that is inflation. Part of that is that there are more baby boomers taking care of not only their parents, but there's more baby boomers that are actually going into assisted living, nursing home, and in-home care. More times than not, you should keep if you already have been approved, you should keep the policy that you have. Some shopping tips, and then we're closing it down right now, so hold your attention just a little while longer. Check out the companies that you're going to buy from. This is your investment in your retirement plan. So you need to make sure that those companies are A-rated or better. Okay, there's no need. There are C-rated companies, B-rated companies, and those are not necessarily bad companies. But you know what? There's a lot of companies that are A-rated, and you don't have to buy from a B or C company. Okay, I like the KISS method. Keep it simple, stupid. Understand this policy. Okay, you need to understand this policy. There's a lot of agents out there that will say, "Oh, well, you just let me take care of it." Okay, there's a lot of technical stuff. Just sign on the dotted line. If an agent tells you that, you need to get a new agent, because if this is insurance is not rocket science. Okay, you need to understand what you're purchasing. Okay, take your time. Have an agent that will help you with outlines of coverage and what is covered and what is not. Do not be misled by advertising. I won't mention any companies, but I'll say this as bluntly as I can. You should not buy the policy by the squeeze toy that you get, or how nice the marketing pin that they give you is, or the flip-up calculator, and on and on and on. This is not a good reason to pay for a company. Well, look at this doll I got. Isn't that nice? And then you don't even know what the coverage is. That is not a good way. Never pay cash for a policy. If an agent ever asks you for cash for a policy, run the other way, because number one, that's illegal. Number two, no agent should do that. Okay, a check or a check made out to the company, a money order, or a draft notice should be what you receive. Don't purchase more coverage than you can afford. There's no point in giving yourself a policy that you can't afford. Hopefully, the agent that you're working with won't do that. I already said make sure the company is A-rated. Make sure that your company is licensed and insured with $1 million or better of E&O insurance. That's errors and omission insurance. Please do not buy from a fly-by-night kind of person. These persons that are just out for sales. You want to find an established, trusted person. I would consider bank drafts are very good because that keeps you from ever having lapse of coverage, because that money comes out automatically out of your account. A lot of people don't like that, but I encourage it. Most policies will have a 30-day free look. Essentially, once you get the policy, they'll send you the policy and you get to look at it, thumb through it, and you have 30 days where you can get refunded for your additional premium if you see fit, if you decide you don't want the policy. Big, 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 big. Buy from a trusted agent. Buy from somebody that you know. Buy from somebody that has their act together. Please do not go to a fly-by-night kind of company. Ask for references. Do not be afraid to ask questions. There are a lot of agents that get so busy and I'll just take care of it. Don't worry about it. You need to understand what you're purchasing. Okay? This is not a small purchase. So you need to understand what's going on and do your homework. Do your homework on the company, the agent. Ask for references. These are some companies and websites you can go to find out companies' ratings. Most of you have heard of Standard & Poor's, Moody's, Fitch, AM Best company. They rate companies' ability to pay your policy. Okay, so that's very important. And this is the last thing we'll go over real quick. Retirement tips. If you haven't started thinking about your retirement, please do. Please start now. If you're sitting in the audience and you are 20 years old, you need to be thinking about your retirement, because no one else is going to. No one's going to do it for you, and you need to do that. If you don't have a will made, you need to have a will. Okay? Any attorney at your church or friends, you can find someone to do your will, $100, $150, and set up the way that you want your final expenses taken care of. Otherwise, the government will figure that out for you, and you don't want that. Find a financial advisor or tax advisor. I read a book that said, don't step over pennies. Don't step over dollars to pick up pennies. Essentially what he was saying was there is great care and there are good agents out there, and there are ways to make yourself more financially knowledgeable about what you're doing in your retirement. Don't say, oh, well, this book costs $15. I'll wait till it goes on sale. Go on and learn about your own retirement. This is one we all tell ourselves. Be more healthy. If you're smoking, if you're morbidly obese or overweight, which my family certainly struggles with, I struggle with weight issues, this is very important. Smoking and obesity are the two number one most disease-causing agents that are most preventable of anything. Okay, smoking's number one, obesity is number two. They increase every health issue that you can think of, from osteoporosis, heart failure, stress, diabetes. All of these are increased by these two factors. I want to thank you for coming to my presentation. I hope you've learned something. I hope that if you have any questions, you will go to my website, www.bigbenefits.homestead.com. It should have been on the bottom of the screen as we've been talking. Also, my phone number is there. And if you'd like to contact me, see me after our seminar, I would greatly appreciate it, and I will answer any questions that you might have. Thank you, and thank you for coming.